Let's take a moment to talk about Uber stock. It's all over the media, and it looks like they'll be IPOing soon. They did just file their S1, and though they do want to razzle-dazzle with all their growth prospects, the milestones they've achieved, and their ultra-adjusted metrics that make them look a lot more glamorous than they are, the reality is their S1 filing presents a few red flags. Uber is expected to IPO with a valuation somewhere in the $100 billion range. Here are 3 reasons why the company is a lot more riskier than you think. Number 1, the company is worth over $100 billion and they are not profitable at all. Furthermore, their management team has outlined that there is a possibility they won't be profitable in the near future or at all. The markets that they compete in, primarily Uber Eats and ride-hailing, are not only very competitive but increasingly becoming more competitive. They provide a service that lacks differentiation and therefore pricing power. Number 2, legal and regulatory risk. Uber drivers are considered independent contractors. Why? Because they can work whenever they want, for how long they want, and they are more than free to go work for a competitor. These are the grounds in Uber's legal battles as to why they should not be registered as employees. However, Uber drivers are fighting against that. However, from the perspective of the drivers, they work long hours for this company and they believe that some benefits should be recognized. The problem is recognizing employee benefits is costly, and as of right now, they are already not profitable. Should they be legally overturned and forced to recognize drivers as employees, I can only imagine how much more unprofitable they would be. This is a big risk to the company. Number 3 is valuation. Because Uber isn't profitable, we can't value them from an earnings perspective, but they do have sales and therefore a sales perspective will suffice. Uber made about $11 billion in sales last year, and because they are expected to be valued at a bit over $100 billion, that is a price to sales ratio of around 9. Now, any value investor or fundamental investor will tell you that is a very lofty valuation and is overvalued in relative terms. Relatively speaking, the average price to sales ratio in the S&P 500 flutters around 2 to 3. And a price to sales ratio of 9 for most people is absurd. But that is the valuation after all, based on the figures Uber is giving us. So for all potential investors, I would be wary of this stock, at least in the short term. It is true that they have an attractive service. I use it all the time. And it is true that they are growing. But if Lyft's IPO is any indication of what's to come, their stock did tank shortly after IPOing. I can't help but feel and have convictions that if you are interested in buying this stock, you can probably get it for cheaper in the future. Once again, guys, thank you for watching. Give us a comment, like, and subscribe if you like this content. And happy investing.